Today, we're about to unravel the 12 critical mistakes that even seasoned investors fall prey to. But before we plunge into this enlightening journey, don't miss the chance to enhance your financial knowledge. Check out the video description below for a curated list of top-notch personal finance books that have personally transformed my perspective. By using the provided links, you not only enrich your understanding, but also contribute to supporting our channel's commitment to delivering valuable insights. So, brace yourself to glean from Warren Buffett's timeless expertise and pave your own path to financial prosperity. Timing the market. Picture this, the elusive art of market timing, where investors attempt to unlock the secrets of the stock market's unpredictable swings. But even the most seasoned investors, like Charlie Munger and Warren Buffett, admit that this pursuit is a perilous journey. Countless variables, like COVID, interest rates, and inflation, can unexpectedly steer the market's course. Instead, why not follow the footsteps of the Oracle of Omaha and focus on something more within reach, identifying exceptional businesses at reasonable prices? Embrace the allure of tangible opportunities and let go of the seductive illusion of market prediction. Getting attached to your purchasing price. Imagine three investors, Arnold, Ben, and Katie, all intertwined in the unpredictable world of stocks. They each bought Amazon stock at different times. Arnold boasts a recent 5% return, feeling like a savvy market player. Ben, on the other hand, grapples with a 38% loss, seeking the elusive break-even point. Meanwhile, Katie sits pretty with a jaw-dropping 133% return, basking in her past success. But here's the gripping truth. Amazon stock has no sympathy for their emotional attachments. It treats them all the same based on future performance, not past entry points. So accept Warren Buffett's wisdom and let go of past sentiments. Focus on the potential of tomorrow, where smart decisions lead to prosperous outcomes regardless of the past. Aggressive growth projections. In the fast-paced world of the stock market, it is common to come across businesses projecting an annual growth rate of 15% or more. But as Buffett wisely warns, few companies, especially large ones, can consistently achieve such ambitious targets. Chasing sky-high growth rates can lead investors astray, often blinding them to the underlying realities of a company's performance. While expansion is crucial for long-term success, Wall Street's relentless pursuit of growth at any cost can be dangerous, particularly in today's low-interest rate environment. Many high-priced stocks depend on extraordinary growth projections to protect their share prices, but this approach may not withstand the test of time. The key to prudent investing is to focus on identifying superior businesses with sustainable growth potential at reasonable valuations. While the appeal of predicting outstanding growth rates may be strong, it is wiser to seek out companies with solid fundamentals and proven track records. Using a lot of leverage. Leverage can be both enticing and perilous. Buffett and Munger emphatically warn against over-leveraging, as it can quickly lead to financial ruin. Leverage involves borrowing money to invest, magnifying both potential gains and losses. While it may appear enticing to multiply returns, the consequences of over-leveraging can be catastrophic. Leverage leaves investors vulnerable to the whims of the market and the possibility of margin calls, especially during times of market turmoil. Just like playing Russian roulette, one bad move can wipe out an investor's entire portfolio, regardless of their initial conviction or expertise. The lesson here is clear. Leverage should be approached with extreme caution. It is best suited for investors who fully understand the risks and have the financial capacity to withstand adverse outcomes. As his partner Charlie Munger said, there's only 3 ways a smart person can go broke: liquor, ladies, and leverage. Simplifying the buying process. Mistakes are inevitable, even for the great Warren Buffett himself. However, the key to successful buying lies in focusing on 3 critical aspects: the future economics of the business and industry, the leadership, and the cost. Warren Buffett's astute judgment allows him to close deals swiftly, emphasizing the importance of keeping things straightforward. While investment bankers and management consultants delve into exhaustive due diligence, Buffett recognizes that honing in on the crucial factors is what truly matters. It's easy to get lost in the minutiae and miss the bigger picture. Taking a bottom-up approach, Buffett conducts in-depth analysis, but prioritizes synthesizing the information into a clear understanding of the investment opportunity. His methodology involves assigning scores to each category: growth, business, and management, and identifying the most significant information for each. By comparing companies based on their prospects and yields, Buffett selects those with the best potential for success. Jumping 7-foot bars. Simplicity is a principle dear to both Warren Buffett and Charlie Munger. They prefer to tackle straightforward businesses rather than complex ones, avoiding the temptation of attempting the impossible. In the investment world, the notion that the bigger the challenge, the greater the reward, is a fallacy. Unlike in other fields where hard work and perseverance lead to success, the investment industry does not reward difficult mathematical acrobatics or ambitious predictions. The infamous case of long-term capital management, where mathematicians and Nobel laureates made disastrous investment decisions, serves as a cautionary tale. Embrace a broad universe of possibilities. In the world of investments, limiting your options can be a costly mistake. Warren Buffett advocates for a diverse and open-minded approach when it comes to investing. Drawing a parallel to his father's fishing experiences, Buffett emphasizes the importance of being flexible and willing to move on to new opportunities when current ones don't pan out. Opportunities in the investment world are transient and unpredictable. Instead of restricting oneself to a narrow niche, like investing solely in a particular industry or sector, Buffett encourages investors to keep their options open. While some funds choose to focus narrowly to make marketing easier, Buffett believes in exploring a wider range of possibilities to seize the best opportunities as they arise. Patience and selectivity. Trying to invest every day or chase every opportunity can lead to mistakes and poor decisions. Buffett compares investing to a game of baseball, where waiting for the right pitch, the fat pitch, is essential for success. Prolonged bear and bull markets provide different opportunities, and it's crucial not to rush into investments without careful consideration. Buffett advises against impulsive decision-making and highlights the importance of staying patient until the right opportunity presents itself. The art of prudent diversification. Diversification is a topic of debate among investors, and Buffett offers a valuable perspective. If an investor truly understands businesses, owning a select few excellent ones, maybe around 6, can be sufficient for significant returns. Adding more businesses beyond this point may dilute the performance of the portfolio. Of course, he's referring to professional investors or people who know how to value invest. For those who aren't sure, he recommends just buying the S&P 500. Buffett underscores the importance of focusing on the best ideas and avoiding over-diversification. He argues that investors who thoroughly research individual companies should have the confidence to concentrate their investments in those they believe in most. Beware of confirmation bias. The human mind is predisposed to interpret new information in ways that support existing beliefs, a phenomenon known as confirmation bias. Buffett and Munger recognize this human tendency and warn against falling into the trap of sticking to preconceived notions. Investors must strive to remain rational and critically evaluate all available information about their investments. To combat confirmation bias, Buffett suggests adopting 2 techniques: the darling-killing funnel and the bear pill. The former involves researching many candidates before selecting the best, while the latter prompts investors to deliberately investigate potential drawbacks of an investment before committing. Resist the herd mentality. In investing, following the crowd can lead to disastrous outcomes. Buffett emphasizes that success in investments often requires counterintuitive decisions and going against the crowd. Many investors tend to be wrong about market moves and stock picks, so blindly following others can be detrimental. Buffett advises investors to stay true to their own research and analysis, even if it means going against popular opinion. By doing so, investors can avoid costly mistakes driven by irrational exuberance or fear. Omissions and the cost of inaction. While mistakes of commission involve taking the wrong actions, Buffett points out that inaction can also be a significant mistake. Failing to act on a valuable opportunity can lead to missed gains and lost potential. Buffett recounts instances where his hesitancy to act cost Berkshire Hathaway billions of dollars in potential profits. He advises investors not to be overly attached to initial purchase prices and to act decisively when they recognize a compelling opportunity within their area of expertise. So, by heeding their lessons and avoiding these 12 common pitfalls, you can navigate the market with greater confidence and insight, positioning yourself for long-term success. Embrace these principles, empower your decisions, and embark on a journey towards prosperous investing. If you enjoyed this video and want more valuable content, click on the suggested video on the screen and consider subscribing to my channel. Until next time, keep calm and compound on.